Good morning to you all. Good morning. The first thing I would say is, travelling up from Southampton this morning, I thought the traffic into London would be okay. But my goodness, as you get closer to London, it's quite an experience actually fighting through the traffic. So it's great to be here, great to see you all. So why am I here and what we're going to do? First of all, Raffingers had asked me to speak to you about inheritance tax planning, and touch on the pension changes. Before I do that, it's a great passion of mine is generation wealth planning and looking at areas where we can help families in terms of IHT strategies and so forth. I'm going to make it enjoyable. I know there's one Scotsman in the room who can understand what I'm saying. I'm sure that we can extend that to others. So in terms of myself, I don't give any advice to anyone. I represent Old Mutual Wealth. All of the business we do is through independent financial advisors. So there is no advice, no dealing with the public that I get involved in. My function is just to impart good technical information that you might find useful in terms of your professional dealings. So that's my introduction. But what we're actually going to do, why are we here and why are we going to actually make it interesting? We want to look at inheritance tax. Very important, but the key aspects. Many of you will be familiar with inheritance tax, but we'll look at it as a refresher if we may. Then we'll look at some of the exemptions that are available, and indeed a facility called the nil rate band. We'll look at ways to actually reduce perhaps IHT in a bona fide way in tried and trusted manners, touch on trusts, touch on wills, and I've been asked to actually make a few comments about the pension changes that are coming through in a matter of weeks. I suppose, is it fair to say, are most of you aware of the pension changes that are coming in a matter of a few weeks? So we're going to touch on that from an inheritance tax point of view, but obviously it's quite a profound change. So that's what we're going to cover. But basically, inheritance tax, in terms of the law, the ability or the government's desire to collect tax revenues on one's passing has been around for literally centuries. It was called, your own parents may remember it as estate duty. It then moved on to capital transfer tax. And the current regime that governs the tax that we were all going to ultimately pay is that governed by the Inheritance Tax Act, which came into play in 1986. So inheritance tax is why we're here. Why is inheritance tax, before we look at our own personal circumstances, why is inheritance tax important to the government? Well, I think it's a major contributor to, obviously, revenues. It's projected that by 2018, the income that one will attract through inheritance tax will be about 6 billion. Currently, the government collect about 4 billion in inheritance tax when people move on. One of the significant reasons for the increase in potential revenue over the next few years is simply that there's a vehicle called the nil rate band. We're going to look at the nil rate band in a bit of detail, but it's actually been frozen for a number of years, and it's actually set to be frozen further to 2018. The effect of that sort of freeze, coupled with house inflation, asset inflation that we've enjoyed over the last few years in terms of investment portfolios, mean that more and more families are falling into the inheritance tax net. And currently about 10% of those passing on actually face an inheritance tax liability that one could, if planning was in vogue, actually mitigate. So that's basically why IHT is important to the government. But who actually pays and who is it actually relevant to? Inheritance tax is for those that were born and bred effectively in the United Kingdom. However, that's only half the story. It could be that one could have been born overseas but have now settled, reside, their permanent home is now the United Kingdom, and they've been here for about 17 out of 20 years. From a technical definition, that means that they are deemed domiciled, which effectively means that their assets worldwide are now subject to UK IHT. For those individuals who have been born overseas, but have actually only been in the United Kingdom a period shorter than 17 out of 20 years, there's an opportunity to ring fence non-UK assets into what is known as an excluded property trust. But for the purpose of our session today, we will focus specifically in terms of the United Kingdom and the tax implication for ourselves. But basically what is IXT is very simple. The graphics look pretty horrific here. I don't know who produced these slides. But the key point is it's a tax. When is it payable? On death and on certain gifts that we make during our actual lifetime. And we're going to look at that time period in a second. So it's death and certain gifts. And it's basically all assets that one possesses on passing, wherever those assets are situated in the globe. So UK property, Spanish property, bank accounts in Switzerland, et al. All of those are actually swept up into the actual calculation, which then is subject to the inheritance tax rate, which we're going to look at now. Basically, anything above a magical figure called the nil rate band is subject to 40% tax. And most of you are already aware of that, I am sure. The nil rate band has been around for many, many years. It grew significantly at its early days, but it has actually been frozen, as I've said, for a number of years now. And you could actually describe that as like a sort of an allowance above which one pays inheritance tax. And as I say, frozen to 2018, which basically means as house prices inflate and indeed our property, our investment portfolios, the actual tax take potentially will be increasing as well. So basically, if we look at a couple of examples, if a client's got an asset which might be modest in this part of the world perhaps, but maybe not so much in Scotland, house worth 750,000, car, savings, total assets just short of 900,000. If that's maybe a sort of typical client in the UK perhaps, the tax implication will depend upon one's marital status, but if one is single, the crude calculation is simply what is the value of my assets, wherever they're situated in the globe, less the nil rate band, which is 325, taxably state in this example 550,000, 555,000. Tax, crudely, is 40% payable before the funds are actually released to our loved ones and family members. So that's a single individual. If one is married, slightly better story, in so much as the nil rate band, which we're talking about, the 325, is doubled up to 650. And we'll talk about transferable nil rate bands in a wee second. But significantly, there's 2 nil rate bands available to married couples and indeed civil partners from 2005 going back. Taxably state in this example 230. The tax liability in this particular example, £92,000. So that's basically, in a nutshell, how the calculations come together. Nice and straightforward, no magic. Just pay one's executors, just simply write a cheque to HMRC and everybody's happy, the monies are released and away we go. Who pays the tax? Obviously executors, for those that have made wills, obviously paid. The tax is obviously settled before probate and the release of the estate. I presume most of you have made wills. I'm hoping that all of you have made wills. And the key thing about any will is to make sure that it's up to date and refreshed as time goes by to reflect one's requirements. So that's how you actually start the calculation, but how can we actually look at legitimate ways allowed by HMRC to reduce the value of the estate? Well, we can make exempt transfers. So that's one of the bona fide solutions. We'll look at that, some examples. Potentially exempt transfer. So the key thing there is it's an exempt transfer, but it's only potential. So something might happen to prevent that from being realistic. Or chargeable lifetime transfer. And we'll look at each of the individual components. Exemptions. The first one is the major one, I guess. It's been around for a long, long time. Is the transfer between spouses and indeed civil partners, which has obviously come into play in the fairly recent past. So that's a spouse exemption. Oops. Okay. Yep, transferable nil rate band I touched on a few minutes ago, and it's important just to actually stop to discuss that. This was a new tool, a solution that was introduced by the Labour government in 2007, which was actually very beneficial. Basically what it was saying is that husband and wives, when one passed away, the nil rate band that belonged to the husband or the wife actually can now transfer across to the survivor, so that the full nil rate band of the first to die, 325, is actually claimed on the second death. So potentially there's 650,000 available for married couples or indeed civil partners. The key thing is that it may be that with good planning or second marriages, that it may be that a will or a trust was actually created on the first death, so that the nil rate band was already used up by the said deceased. So that depends on one's individual circumstances. But whatever has happened on the first death, anything that was unused of the nil rate band, because it may be that the mother who went first, shall we say, she may say X pounds to said children. So there may be of her estate an unused percentage of the nil rate band. So that can actually now be claimed on the death of the second to pass away. So that is a significant improvement, and indeed throughout the United Kingdom, that actually removed, that change actually removed quite a number of estates from the potential of inheritance tax. So that's a very positive step that came through. Other exemptions, there's a small gifts exemption. I don't think it's very significant. You can give £250 at Piccadilly Circus to everybody that walks past, but who would actually want to do that? So that's really a token gesture at best. One that should be used, and when I do these talks all over the United Kingdom, I'm amazed that the annual exemption is not actually used on a more regular basis. Annual exemption, just as a reminder, is basically the ability for each and every one of us, every year, to make an exempt transfer of £3,000. If you haven't done it 1 year, you can go back 1 year, so effectively mop up 6,000, and that can apply to both husband and wife. So that's an annual exemption, a legitimate way in statute to remove a small amount every year from one's estate. And it's one thing that one would always encourage to do without a question. And as I've said, it's amazing the amount of clients and so forth who don't actually make use of that particular facility. So that's the annual exemption. The other one is exemption is out of normal expenditure. That would be for the client perhaps who's got surplus income, and it's got to be from income. Surplus income, their income needs maybe 30, but they're getting 50 coming in on a regular basis. So they can actually use this particular expenditure, or this particular exemption, sorry, to actually make the exempt transfer without it disturbing their standard of living on a regular basis. And that again is another device that can be used for life policies and so forth, and we'll come back to that in a wee second. Is this as exciting as you expected when you woke up this morning? Other exemptions, for those that should desire, is gifts to political parties are exempt up to a certain value. Charities, exempt again, and gifts for national art galleries, etc. If 10% of the total estate is gifted to charities, then the IHT bill reduces from 40 down to 36%. So there's been a few adjustments in recent times in terms of charitable giving. So those particular exemptions are exempt transfers. There are others that are called potentially exempt transfers, and we're going to look at that as we do. What are potentially exempt transfers? The key thing is that they are only potentially exempt. That's why I put it in red, potentially. These are gifts that one makes whilst we are alive. There's no tax there's no actual tax when one makes that payment. And if one survives 7 years from making the payment, the actual transfer of value is then out of one's estate. So I was talking to a gentleman earlier, he was saying maybe I've left a wee bit late, and I said no, I don't think that's the case. And this is where potentially exempt transfers, where you can actually give money to sons, daughters, survive 7 years, and the money is then bona fide out of the estate. So that's potentially exempt transfer. Some examples I've touched on is gift to another individual, so I would say son or daughter to help with a house purchase or whatever. It could be that one wants to actually make a gift into a trust, perhaps for the benefit of grandchildren or whatever. So gifts into trusts, these are deemed to be potentially exempt transfers. A bare trust we'll talk about in a wee second, but that's where the beneficiary is named. The essence of those particular gifts is once you've made the gift, it is a gift, it's irrevocable. So you've actually made, you can't say I'll give it to you and then I'll take it back. So it's gone forever to said recipient. And as I've said, the key number is 7 years to survive. The key thing is what happens if one passes away within the 7 years? Has that then been a waste or not? The good news is that there is a sliding scale taper relief that actually helps that particular consequence. And the sliding scale is that if one passes away within 3 years, effectively there's no relief in terms of the value of the gift. But the closer one gets to the magical 7 number, there is less tax take or less IHT payable on the value of the gift that's been made. So it's always, and you know, when I look at individuals throughout the United Kingdom, a lot of people do potential exempt transfers for the reasons they want to give money to their sons, daughters, family members, etc. And it's always, people always talk about starting the clock, getting the clock ticking now, because if the longer you wait, then perhaps the 7-year opportunity is not as great as it would be starting sooner rather than later. So that's basically PET, that's taper relief. The other one that, so we've looked at exempt transfers, potential exempt transfers. There's another one, chargeable lifetime transfers. And this isn't a technical section by any means, I'm trying to make it as simple as possible. But what do we mean by chargeable lifetime transfers? These are basically lifetime gifts, like the PET that we've taught, the potential exempt transfer, where one needs to survive 7 years. But the difference with those particular transfer of values is that these are gifts into a discretionary trust. And when we say discretionary trust, we're going to look at that in a bit in some detail in a second, but a discretionary trust is one where there is complete discretion as to who may enjoy the benefits of said trust from a prescribed class of beneficiary. And there may actually be a tax implication on investing into the discretionary trust. Anything above the nil rate band, the magical 325 that we've spoken about already, would be subject to a 20% entry charge. But I don't want to put you off the discretionary trust because I think they're very powerful in the right environment, and we're going to look at trusts by demand in a short time. So the 7 years is a magical number. One of the key things we always say with inheritance tax is, and this was very much in vogue before 2004, 2005, there's a lot of schemes whereby individuals may be staying in their house and they decide to actually sell their house to their sons and daughters, but still reside in the property. That's where the government at the time wanted to clamp down on that. So that would be deemed to be a gift with reservation, because you're actually giving it away, but you're still enjoying the actual said property. There's certain ways around that in a bona fide way. One needs to pay market rate of rent, etc. But anything that whereby you still enjoy the gift that you've made would be either verboten in terms of being a gift with reservation. And if the government don't catch on gift with reservation rules, they introduced in 2005 pre-owned asset tax, which was basically, if we don't get you on the gift with reservation condition, and this could perhaps be like a painting, for example, a valuable painting, a work of art. You give it away, but you still see it on your wall. That would obviously, you're still enjoying it, even though the owner has now been passed to another person. The revenue would say that there should be an income tax charge for the enjoyment of having the enjoyment of the painting or the piece of art on an annual basis, and there's a calculation for that. So that's basically pre-owned asset tax. Have many of you heard of pre-owned asset tax? Is that an expression you've picked up on the press or so forth? Gift with reservation, is that something that we've come across perhaps in your readings and so forth? So the key question is, we've looked at exempt transfers, potential exempt transfers, chargeable lifetime transfers. We know there's a nil rate band. We know it's transferable to civil partners and spouse, which is a an improvement which came in 2007, as we said. But how can we actually reduce the liability in a bona fide way? Tried and tested routes, first of all, would be perhaps a life assurance policy, just a straightforward life assurance policy. So if one knows the liability on passing, if we work out our assets, if we pass away today, we know that the potential tax bill may be 40% of whatever. One could actually take out a life policy, that would be the sum assured, it could be index linked or whatever, for example, and that would generate the proceeds on passing that could then be used to actually pay off the IHT liability. The one thing we always advocate and stress is that any policy that is taken out is actually written in trust, because if it's not written in trust, all you're simply doing is actually inflating your own estate, because the money in that case would form part of your own estate for IHT purposes. So the key thing is making sure that if you already have a life assurance policy in play, that it's actually written in trust for the benefit of the beneficiaries. And it's amazing the number of individuals that do take out policies and they don't actually put them into trust, or they forget, or they'll get round to it at some point in the future, and that time sadly sometimes doesn't actually come. So we always stress that. The other bona fide way is to obviously make gifts, which would be the potential exempt transfer, and survive 7 years, or to use trusts to shelter the assets so that they can actually be used by the beneficiaries when the trustees determine when those monies should be allocated. And I've put bona fide on the slide because there's been a lot of press recently about tax avoidance schemes, retrospective action, HMRC, and I'm going to touch on that because I think that's very, very valid in terms of our discussions today. When we talk about trusts, the danger is, I think, that it can be made extremely complicated, and trusts can actually frighten people away. A lot of people say trust planning is for the preserve of the super wealthy and not for Middle England, if I can use that expression. I would actually totally disagree. A trust is actually a very simple concept. It can be made very complicated if one wants to make it complicated, but equally it can be made very, very simple if one wants to go that particular route. By that I mean, what is a trust? Basically, as it says here, it's just the means whereby if I own the money or the property, the assets, I transfer the ownership from myself to trustees. I can be a trustee. So all I'm doing is legally changing the ownership of my capital to a trust. I'm the trustees, and I can have my family as the beneficiaries of that particular trust. And we as the trustees, along with my wife, we can determine who and when should receive those particular funds. So the trust concept is very, very simple. And as you see, it's all about making sure that we can provide for the beneficiaries, but without giving them the control and access to the monies, perhaps at a time that's not appropriate. So it gives us control for the future. So from a legal perspective, in a nice simple way, it's a legal obligation binding the trustees, and normally we'd always advocate there should always be at least 2 trustees in any trust planning we do. To have one trustee is opening up the challenge for a difficulty, because if the trustee passes away, what happens next? Who assumes obviously the ownership? You've got to go through certain legal process, and that can take a lot of time. So always 2 trustees we would recommend or more. Their function is just simply to look after the trust assets in accordance with the wording of the trust deed. And it's been created simply for the benefit of the people that you or the settlor, persons putting the money in, should so decide should be the beneficiary. So it's really, in legal terminology, it's very, very simple. Very, very simple. But it can be made very complicated by those that perhaps have an interest in making it complicated. So why bother having a trust? That's the key question. Why bother? Well, first of all, the settlor, I putting the money into the trust, I can control in my trustee capacity who should get what and at what point. So I've got complete control over the destination of the funds, control over the timing. There might be taxation benefits because when I put the money into the trust, the 7-year clock that I referred to earlier, the PET or the CLT, and we'll come back to that expression in a second, the clock starts ticking now because I've made the transfer into the trust today. It may be that it's a means to actually provide for those that don't have the capacity to contract, which would be children, and obviously on passing we don't need to worry about probate because the money is already in the trust, so access to the funds is speedily. So that's why you would have a trust, but we need to actually now step back a second, I guess, and think trusts can be made very complicated. I'm sure anybody who's looked at the HMRC website, and I know that a few of you have had a look at it, it can be rather daunting when you see all this about trusts. However, what about experience of those who have already effected trusts? HMRC carried out a survey of about 2,000 trusts a few years ago, just to get a flavour as to why people set up trusts and their experience, just to get a picture as to why trust planning is actually done. And I want to share some of it with you. I think this is very important. That's the first observation. So the key motivation is to control family assets. I would call it bloodline protection. I would call it generation wealth planning, to ensure that the family money stays within the family for the benefit of the members of the family. And that's basically the experience for those that have set up trusts, to control the assets, not as a tax dodge. And that, I would like to stress up front, is not the findings of HMRC. It's to control the distribution of family money to the intended parties. So in terms of actually extending that further, so the first motivation is provide protection, gifts to the children, the family members. If one can actually save tax in the process, that is desirable, but it's not the main motivation, or hasn't, from evidence, has not been the main motivation for actually creating the trust. And the beautiful thing is, if you can bring the two together, provide for the family, the generation wealth planning, the bloodline protection, and at the same time actually save on inheritance tax as well, then you've actually got a utopian type solution. Once money's in the trust, the key question is, when will the beneficiaries actually get access to the spoils, the trust assets? Obviously, it will depend on the type of trust, it will depend on the aspirations, because the key thing is the trustees call the shots, because they own the money from a legal point of view on trust for the beneficiaries. The interesting thing is that only on 13% of times when the actual settlor passes away is money then distributed to the beneficiaries, the children, for example, which I was quite surprised with that. A lot of people say to me, when I pass away, the money will automatically go to my children. With the use of the trust package, the trustees can actually time when the money should go to the said children or beneficiaries. So it gives control and timing aspects. In about a quarter of the cases, no fixed date. The trust can actually run for many, many years, decades. There's a perpetuity period for reasons that we'll come on to, but the flexibility belongs to the trust wording and indeed the trustees. I think this is an interesting one. With the divorce rate in the United Kingdom, I think it's 1 in 3 currently or whatever, one of the great concerns of parents, and I'm a parent, is that you've made your money and you want to give it to your family members. The family members regrettably get married, or they thankfully get married. But then regrettably, somewhere down the road, things go wrong. And that's what happens. We know that happens. That's just a fact of life. We can't change it. And if we can actually look at a solution through generation wealth planning to make sure that the property that belongs to the Smith family stays with the Smith family, rather than half of it going to the Jones family further down the track, that would be sound financial planning. It actually goes beyond inheritance tax planning. It goes to actually a wider generation wealth planning. And I think that's an area where it then becomes rather interesting. I'm sure you'd agree. I hope you agree. How's the Scottish accent, by the way? Are we all keeping up to this Scottish accent? So we've looked at, so that's basically the trust research as to why people set up trusts. But I think it's very important, just to step back and think of recent press headlines that we've seen about tax avoidance schemes. Most weeks when you actually read the newspaper, there seems to be some celebrity has been caught up retrospectively, not doing anything wrong, but retrospectively rules are changing, the government's revisiting tax avoidance schemes and making adjustments to them. So it's very important, I think, we touch on that and put that in context with some of the solutions and ideas we're talking about today. I think in recent times I've seen Gary Lineker caught up in a particular case, Carr last year, Gary Barlow, to name but a few. Basically, what's actually happening here is HMRC correctly began a campaign in 2012 to crack down on tax avoidance schemes and tax evasion. Obviously, one's completely off the scale. Tax evasion is obviously illegal. Tax avoidance is perhaps one of these grey areas, and we'll look at that in a second. But basically what we're saying is there's too much, in the austerity period, there's too much tax leakage. Within the United Kingdom, the tax leakage actually is very, very healthy compared to a lot of other nations throughout the globe. But George Osborne was adamant that, hey, we need to actually recoup income tax, or otherwise that we're not receiving that we should. So they started on this campaign. You may have seen it in bus shelters, tube stations, blah, 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 this advertising campaign. They've had some victories, they've had some losses. They've had more victories than losses, that's for sure. They've introduced a new regime a number of years ago called the disclosure of tax avoidance schemes, which basically was saying when you're promoting those kind of schemes, make sure we, the revenue, are aware of them so we can actually run our eye over them. As a result of this particular legislation, they've closed quite a number of schemes that were in situ. They've recouped the potential tax that would otherwise have been leaked from the system. They've actually recouped a significant number. The trusts that we are speaking of today, and we'll look at in a wee second, are tried and tested. So they're going to be non-contentious, but we'll come back to that. The tax evasion strategy is actually a global tax evasion strategy. It's not just the United Kingdom, there's about 50 nations throughout the globe that are now sharing information broadly for the very first time. If you look at banking secrecy in Switzerland, that's obviously no longer secret. Liechtenstein and other parts of the globe have obviously opened up. And it's only those nations that are now, that don't come forward and share information, that really are on the zones to be completely avoided. Because if they don't want to share the information, then quite clearly they're obviously hiding assets, which is a non-starter. So basically the Revenue produced a paper in 2014 called No Safe Haven. Wherever your money is situated, we want to know where it is, and we want you to declare your income tax or otherwise on that money. How they've done it is they've employed an extra, last year they employed an extra 2,500 people, specifically to target tax avoidance and tax evasion. So that's looking at obviously certain individuals' tax affairs. They've run the campaigns that I've talked about. They're ahead of target in terms of the recoup of potential tax leakage. They've recovered 23 billion as a result of this, so they're actually quite pleased with what they've achieved, and quite rightly. Under the disclosure regime of bank accounts offshore, whether it be in Switzerland or whatever, 56,000 residents of the United Kingdom have come forward and says, I have a bank account in Geneva or Zurich or whatever, and I want to make good my tax return. So this has actually been quite a big event. And as I've said, there's now about 50 jurisdictions worldwide sharing information. And the United States is obviously one of the leaders in that particular area. Do we have anyone in here from the States today? Are we in the States? No. Okay, because that's... No. Are you from the States? You're not the States, no. Sorry? Oh, you got a dual passport, right, okay. That's even more interesting. Which we're not going there. We're not going there. Boris Johnson, yeah. Yeah, we're not going dual passports, okay. But that is interesting. But I think the key thing is that from HMRC's point of view, and I think this is important in terms of positioning for what comes next. There's a formula, there's method in the madness. Basically, if we look at the bigger picture, the pension tax-free saving, I don't know so much tax-free, but the pension regime, the ability to contribute to pensions, as we know, is getting tighter. We had a lifetime allowance, 1.8 million a few years ago. It's now been reduced to 1.25, and there's talk that it might actually be reduced further. There's talk that perhaps some of the funding for other benefits and so forth may come from reducing additional or higher rate tax on pension contributions. So we know that pensions are getting a bit tighter. The annual allowance was 50, it's now 40. We lose our personal allowance once we get to £100,000 worth of income. The nil rate band, as I've spoken about a few times now, is frozen. The global crackdown in offshore accounts. So where can you actually invest money confidently and sleep at night knowing that what you're doing is actually bona fide and in particularly good taste from HMRC's point of view. Before we come on to trust, I think it's important that for those that have been around a long time, and that includes obviously myself, in a lot of respects, one can go back to basics to find solutions that are bona fide, straight down the middle from a golfing analogy, whereby there are excellent tax breaks to be had, looking at solutions that have been around for decades that have, in a lot of respects, in recent times been overlooked, purely because of the popular press saying they've not been good value. There are vehicles on the market called investment bonds. These are bonds that have investments within them. And the taxation regime broadly that governs these particular solutions is enshrined in law a way back when Manchester United first won the European Cup, 1960. And I don't know whether there's any Manchester United supporters in here. I wouldn't have thought maybe too many here, but anyway. So basically the legislation governing bonds goes back to 1960, as we've seen. And why is that attractive? The key point is that those particular instrument solutions are deemed to be non-income producing. Because they're non-income producing, when the owner, and whether it be a trust or otherwise, there's no requirement to actually declare any income growth on their tax return on an annual basis. So basically the attractions of that type of solution, and this is going to knit in with the solutions when we look at trust planning in a second, is that depending on how one structures these solutions, there's potentially no tax returns required if money is not taken out for up to about 100 years, depending on where you invest the money, potentially no tax deductions on the money. The key point is that if one wants to take income, a return of capital, then one can do that. And broadly that would be 5% over a 20-year period, so a 65-year-old can get income at 5% for the next 20 years without paying any tax on that money or doing any tax returns. They can use the vehicle to protect the bloodline, so it goes back to bloodline protection that we looked at. Protect from creditors perhaps in terms of business failure if one uses an appropriate trust. Retain control, but crucially the reason we're here today is that one can also save inheritance tax using this kind of device subject to a suitable trust. Either now or if it's too early to do inheritance tax planning now, one can put the structure in place today but add the trust for IHT purposes sometime in the future. And it's a vehicle that, as I say, largely has been overlooked in recent times, but it's tried and tested in terms of its bona fideness, if that is such a word. Why is an non-income producing asset useful? Because there's no tax until something happens. And I don't want to dwell on this because this is more like a technical session, but basically there's no tax until something happens, and that something happening would either be death or taking money out beyond the 5% tax deferred allowance. So that's what we need to know, I think, about the bond solutions. So why bother? Why bother with trust planning, bonds or whatever? Well, I think the key thing is to protect our children. That should be number one, I guess, or loved ones, extended families. Protect the assets that one has built up. Save inheritance tax in the process, but the IHT might not be the main driver as evidence from HMRC. And if we look at a couple of typical clients, it might actually give you a flavour as to where we can actually put this into practice. Because hitherto, there's a lot of sort of technical mumbo-jumbo, But if we actually bring it into the real world, who can actually benefit? This is we've got a couple of examples. This is a chap, maybe in his 60s. He's built up his wealth. He's run his business or whatever. His main motivation here is to provide for his sons, his daughters, and future grandchildren so that they can enjoy the spoils of this gentleman and his wife's labour, perhaps for many, many years to come. So it's to provide for the generations. He's concerned that children, if they were given the money at 20, 25, 30, might have a good time, or whatever might happen. So he's concerned about that, and at the same time he wants to protect it from third parties who may come along and perhaps cause a problem. A younger chap, his circumstances slightly different. He's actually started his own business. He's got an inheritance to come through from his mum and dad. But his marriage is looking shaky, for example. So the last thing that this gentleman should do is actually take the inheritance at this time. That would obviously be a disaster, because effectively if the marriage should collapse, then potentially assets that he inherits from his mum and dad could potentially disappear. So how can we actually look at those circumstances and provide a solution that's straight down the middle, bona fide, and does the job? If I just to give you a wee flavour as to how you can use a trust. In that particular example, the gentleman, he could invest, let's assume he's single, 325,000 into a trust. His son, who is subject to obviously perhaps his marriage, blah, blah, blah. So what would actually happen is that the father would put money into the trust. It would be a discretionary trust. So because it's a discretionary trust, the boy is actually deemed to be one of the potential beneficiaries, along with other family members, for example. But the key thing is, the key word is potential beneficiary. Because the word says potential beneficiary, it basically means no one has a legal right to the money in that trust. And because no one has got a legal right to any of the money in the trust, no one can actually make a claim on the boy, because he actually hasn't got any money that has actually been earmarked for himself. So that's what we call a discretionary trust. The trustees could be the father, the 60-year-old, for example. He could be a trustee along with his son. His son could also be a trustee. So they could actually control. But the nature of the trust is designed to protect the family. And discretionary trust, that's where it comes through as a very successful sort of planning, very simple planning tool. The types of trusts, just to draw a broad comparison. There's no examination paper at the end of this, by the way. But basically, the individual putting the money into the trust is legally known as the settlor. There's broadly, in 2015, two types of trust that one would perhaps consider. One is what is known as an absolute or bare trust, as distinct to a discretionary trust. The bare trust, very, very suitable, maybe for children or whatever. The danger with the bare trust is that once you've actually nominated or in the trust deed named a particular individual, then they have a legal right to the monies come 18. That's a legal right, so they can claim the money and say, give me the money if they blah, blah, blah. And more importantly is that you can never ever change that beneficiary. So once the trust deed has been executed, the name in that box can never ever be changed, which basically means that if family matters should change, then potentially those assets could perhaps be claimed upon. So that's the bare trust, as distinct to the discretionary trust. The discretionary trust, no one individual has a legal right to any of the assets in said trust. The trustees, and that's why the trustees, the appointment of the trustees is so important, because their function is to look after the beneficiaries, of course, but they have complete discretion as to who should enjoy the benefits of the trust assets at a time that the trustees should so desire. And it doesn't mean to say that all of the money needs to be distributed from the trust on day one. It can be actually passed out over different years or to different beneficiaries. So those are the two broad. There's one in the middle called an interest in possession trust. Very much in vogue up to about 2006, and then the government changed the rules in March 2006. And whilst still in play, I don't want to dwell on that today. I just want to actually draw the distinction between the absolute and the discretionary trust. Significantly, and I think this is very important, I touched on earlier, potentially exempt transfers, the transfers that were potentially exempt if you survive 7 years. Any money that goes into the bear trust is a potentially exempt transfer. There is no payment up front that needs to be paid into those trusts. That's a really important point. Someone could put £1 million into a bear trust tomorrow and there's no entry charge. As long as you survive 7 years, that money is outside of your estate. On the other side of the coin, you've got this discretionary trust. Chargeable lifetime transfer. Any transfer of value over the nil rate band, the 325 for a single person, would be subject to a 20% entry charge. So one just needs to be mindful of the different tax regime between one and the other. And the team at Raffingers, they would obviously give you that particular guidance as to which one was appropriate for your own circumstances. There's no reason why you cannot mix and match. Some individuals will say, I'll put some money into a bear trust and I'll put the balance perhaps into a discretionary trust. So you can mix and match, but one needs to be mindful of the tax implication. Also on the discretionary trust, not to frighten you away, is that there's a calculation, there's a potentially a tax charge at the 10-year point and every 10-year point thereafter. But that would be moving into a technical discussion, which is not the objective of today. So when those gifts are made, they're effectively irrevocable. You've given the money away, and a lot of clients are concerned that they might live to 100, and they're thinking, I don't want to give money away. So those trusts we've looked at are very much what I would call black and white. It's clear cut. But it may be that a variation in style may be appropriate to harness the joys or the benefits of IHT planning, but still with an access to either some capital or income. So we need to look at those particular solutions now. First one we're going to look at is what I would call the halfway house IHT solution. So it's halfway house, and it's got that description for a reason. And there may be older clients with an IHT liability, and their requirements might be slightly different from the halfway house, whereby they can forego access to the capital. So these are two distinct, different solutions that are bona fide and widely used in the United Kingdom. The halfway house I would describe as, for the typical client, when we look at the work that we do and many people do, the typical age of the client who does the halfway house solution is probably in the 45 to 65 age zone. That is not set in stone, that's just merely a guide. It can be any age whatsoever. These are the individuals who they want to do some IHT planning, but they do not want, they're too young, they don't want to give away access to their capital because they know that they might live for another 45 years. They don't want to give up, they want access to capital, but they may actually want to do some IHT planning. So how would that actually work in practice? We need to look at an example, and we need to spend a wee bit of time on this. Let me explain what's going on here. It's a busy chart. So we've actually got the client who has got £300,000. He's between 45 and 65, he or she. And he says, look, he or she says, I've got an IHT liability. I want to do something about it, but I cannot afford to give up and do not want to give up access to 300,000. So effectively what this individual does is make a loan to a trust. So first of all, it's a loan, it's documented as a loan. Because it's a loan, it's still within the lender's estate for IHT purposes. So it can be recalled at any time. It actually still is in that individual's estate for IHT. Repayable on demand. They can take it back as regular income or return of capital, but on an income basis. Or they can take chunks back as and when they should desire. But the key thing is, why would anyone do it? They would do it because they want to do some IHT planning, whereby, in this example, any of the growth that's enjoyed by the investment of the funds actually falls outside of the owner or the lender's estate, and will be held in a trust for the benefit of the chosen beneficiaries. So it may be a discretionary trust. So this client is actually doing something for the benefit of the family members while still retaining access to the original capital. Some people say to me, it takes too long for it to be of much benefit. And that is typically a response that we get. However, when one looks at the figures, I know of recent times markets have been very kind to us all, but if you assume the actuaries, the mathematicians always say that money doubles every 10 years if we assume 7.2% growth. So in this example, if the client invests 300,000, after 10 years, it doubles to 600,000, and after 20 years, it doubles again to 1.2 million. Effectively, the settlor in this example, or the lender, he would have access to 300,000, he could get that back, that belongs to him. But all of the growth above the 300,000 is actually now sitting in a trust that's built up, obviously, over a lengthy period of time. It's outside the estate. He or she is the trustee and controlling that capital for the benefit of the chosen beneficiaries. So that's the halfway house loan trust solution. Have any of you heard of loan trusts? So is that an expression you've come across? To be honest with you, it's a solution that's been around for actually decades, literally decades. A lot of people just dismiss it because they think, well, how much investment growth has there been in the markets over the last 15 years? A lot of people say the FTSE has only now got back to its previous high. But my goodness, if you'd actually chosen certain funds within that period, like Neil Woodford or Invest Perpetual Income, for example, with dividends reinvested, one would have actually enjoyed a tremendous return over that period, despite the FTSE only getting back to its previous peak. So it all depends where one invests the assets. But a lot of people say it's a slow burn, not worth the effort. But when we look at what Coutts do, UBS, the banks, they would tend to always recommend this kind of solution for the younger clients. And I think it's a bona fide, tried and tested solution. Older clients, and this, again, the age we've got here, 65, can be any age whatsoever. It can be 85, 70. But these are the clients who say, look, I need income for the rest of my lifetime. That's an absolute fact. I need income. I've got an IHT liability, we know that. I want to do something about the IHT for my family. And crucially, this particular client can afford to give up access to some capital to actually get that particular solution. So that's the older client, distinct from the loan trust. This particular one is called a discounted gift scheme. And again, straight down the middle in terms of investment planning. HMRC are familiar with these schemes. They've been around for literally decades. But why would anyone actually buy this particular solution? What is the benefit? That is the key question. First of all, there's an immediate reduction in IHT on part of the premium that has actually been invested into the solution. And I'll look at an example of that for you in a second. The balance falls out of the estate over a 7-year period. So we go back to this clock ticking and the magic number 7. And all of the growth is outside the estate. But crucially, the investor, the settlor, the client, they have the legal right to income, broadly about 5% for the remainder of their lifetime. If we put that into some context, actually. Okay. How it actually works in practice is that the client with the money, or the mother and father, they've got 100,000. They will also probably be a trustee to control. So they transfer the ownership from themselves to the trust. He or she is a trustee along with perhaps the family members. So they're now the individuals legally owning the 100,000. Because of discounted gift trust, what actually happens is one HMRC permit an immediate discount from one's estate. Why do they do that? But more importantly, how does the calculation come about? HMRC prescribe a particular calculation, but basically what it's saying is how many 5%, first of all, is the client in good health? That's number one. the client needs to be underwritten. But when I say underwritten, I don't mean having to go to a doctor for a medical examination or whatever. What we're looking at there is the medical history from the client's surgery. That needs to be made available to the provider. This is relatively recently, up to about the mid-2006. It was often the case that no medical evidence was actually furnished. However, to actually work out the discount and have confidence in the solution, the client has got to demonstrate that they're in good shape. By demonstrating they're in good shape, they basically then qualify for the immediate discount. The immediate discount, what the revenue is saying is, from the underwriting, how many years is the client expected to live from? So a 65-year-old might be expected to live to 80 or beyond, probably 85. So that's maybe a 20-year. They're entitled to a return of capital from their bond, so let's say 5% for 20 years. It's that figure is the amount of 5% that they're actually legally entitled to. It's then discounted to a current market, or to a current value, discounted by interest rate factors. So it comes back to an immediate discount along those calculations, which broadly, when we actually put it into numbers rather than a lot of words, an individual who's 65 in good health who invests 100,000, the typical discount conservatively for a good life, you know, in terms of health, is probably going to be around the 50,000 or 50%. So on 100,000, probably about 50, 55,000. Immediate reduction from the estate. The settlor, the client, has got the legal right to the income of 5% for the rest of their lifetime. And the balance of the premium, in my example, say 50,000 for talking sake, that would then actually fall out of the estate over a 7-year period. So we go back to the magic number of 7 and potentially exempt transfer. If it's in a bare trust or if it's in a discretionary trust, it would be a chargeable lifetime transfer. So that's basically the discounted gift trust as distinct to the loan trust. Another solution in terms of trust planning, which I think is important, is grandparent and grandchild trust. This is basically designed for school fee planning. And it's a sort of combination trust. The grandparents invest the money into a discretionary trust. They invest it into a discretionary trust because they want to provide for current grandchildren, but also grandchildren who are potentially on their way. And they want to actually treat all the grandchildren obviously equally. So initially the money is going to a discretionary trust, but we combine it with a bare trust for tax benefit purposes. Because when school fees become due, the trustees, which would be probably the grandparents plus the parents, they could then decide to appoint chunks, I'm going to call it chunks, from the trust into what we would call a bare trust in the name of the trustees for the benefit of the child. But the key point is the tax is then on the child, and obviously all children have obviously got their own personal allowance, about £10,000. So that can then be a bona fide way of actually providing for school fee planning. The key point is that the monies that go into the discretionary trust in the first place would be a chargeable lifetime transfer from the grandparents. So that is a device to reduce the grandparents' estate for IHT purposes. So that's what we call grandparent-grandchild trust. But who should be trustees in these particular examples? The trusteeship is so important, and sometimes the trusteeship is actually overlooked. It's one of the most important aspects of the whole picture, because it's individuals that we must trust who are going to act on behalf of all the beneficiaries. And as I said earlier, you should always have at least 2 and perhaps more as a minimum on any trust deed. Trustees can be family members over 18, sane, blah, blah, blah. So it can be the family. If one wants confidentiality or whatever, then there's also the opportunity to appoint a corporate trustee, for example. Obviously, one needs to pay for that service, but they would actually offer a bit of confidentiality and deal with maybe more contentious issues if it's a family, it's an extended family or whatever. So I just highlight that there's different ways in which the trustees come together. Typically, for most trusts, it's the family, that mum and dad, plus the potentially plus the children, they can be trustees. But it's a very, very important role that can never ever be underestimated. So as time moves on, I think we're almost at the final whistle. But before we do that, a number of you were asking about introducing or just talking briefly about the pension changes from an inheritance tax point of view. This came as a complete and absolute surprise to everyone. The pension changes that were announced last budget, 2014, came right out of the blue. A complete reform of pension legislation. The biggest change since modern day pensions were introduced. I'm not going to go into it because we could be here all day, but suffice to say the changes for the money coming out of the pension plan have been significantly enhanced for family members. If I just show you a few things here actually. The key thing is to actually cut through the situation. The new rules for pensions come into play on the 6th of April this year. So that's when the new rules come into play. In terms of inheritance tax, because that's obviously the purpose of the agenda here and not actually a pension session, the actual tax treatment on passing depends on one's age after the 6th of April 2015. If one passes away before 75, whether they've already taken their benefits or not, then there's no tax implications whatsoever on those monies. There's no IHT on the money. It's completely income tax free. There is no tax liability on it whatsoever. And that is one massive change from where we sit at the moment, where potentially the tax charge could be 55% of the residual fund. So 75 is a key date. Before 75, no tax implication whatsoever. Beyond 75, it depends what actually happens. But broadly, if one dies after 75, any lump sum that comes out in the first 12 months is going to be subject to a 45% lump sum tax charge. However, going through Parliament at the moment, the small print here is that any money that comes out for the spouse or whatever, for the client who died after 75, there will be income tax on the recipient at their marginal rate. So that could be 20% when they actually receive it. But the key thing is that we've now got this concept of beneficiary drawdown. So we're now thinking, and a lot of companies are thinking, that one can now pass the pension pot down through the generations. So generation wealth planning can actually apply through to the children, down to the grandchildren. Effectively, the money can stay in the pension pot. The pension pot obviously enjoys excellent, virtually tax-free growth, and it can actually be sheltered there without any tax charges, etc., until the money should be disbursed at some point many, many years in the future. And that is a significant change in terms of wealth planning. And it's a change that actually, as I said earlier, has come as a great surprise to many. But it's actually thrown up a lot of opportunities for pension planning. One obviously has got to be careful with the new pension reforms, because individuals can now tap into their pension pots from 55, take all their money out if that's what they want to do. But then what happens, that's the great danger. And obviously anyone who watched Crime Watch a few weeks ago, did anyone watch Crime Watch a few weeks ago when they were talking about fraud? And did anyone see that? Basically Crime Watch actually ran, it was nothing to do with actual crime as we normally expect Crime Watch, but basically it was individuals targeting clients or potential clients in the UK so that they would actually advance their capital to people they'd never ever met through social media and internet. 200,000 people in the United Kingdom every year give out money to people they've never ever met, life savings, etc. And a lot of people are now concerned that with the new pension reforms and freedoms that controls need to be in place to try and help those that are under attack. But we don't need to go there, we don't need to talk about Crime Watch. But what we do need to talk about is IHT, and the pension rules have indeed been for everyone's benefit, there's no question about that. Well, I think we're actually bang on time. I can hear the final whistle. I don't know whether we're going into extra time, penalty kicks or replays. I'm sure you're hoping not. But that concludes my talk with you this morning. IHT basically, to a lot of people, is actually sometimes referred to as a voluntary tax. It's a voluntary tax because we know at any one point the value of our assets and the potential liability. It's voluntary in so much as we could maybe do something about it with a bit of planning. I think this is key, and I would always advocate through Raffinger Stewart in conjunction with Bradbury Hamilton to actually get periodically a free, or not so much a free, but an IHT wealth check to ensure that all of your sort of financial affairs in that area are bang up to date.